Substantive testing is a crucial aspect of auditing, focusing on detailed examination of transactions, account balances, and disclosures to ensure their accuracy, completeness, and compliance with relevant standards. It also involves transaction testing, which includes verifying individual transactions such as sales, purchases, and journal entries. Secondly, balance testing that highlights the confirmation of account balances like cash, accounts payable, and inventory. We also have disclosure testing, which is the reviewing of financial statement disclosures like footnotes and schedules. Herein, we have transaction testing, balance testing, and disclosure testing. Now, it is important to know that substantive testing aims to gather sufficient, appropriate evidence to support audit opinions on financial statements. It helps auditors to 1. Identify material errors or fraud. 2. It helps auditors to assess risk and materiality. Thirdly, it helps auditors to evaluate internal controls. And fourth, determine the reliability of financial reporting. Substantive testing is performed using various techniques, which includes inspection of documents and records, confirmation with third parties, for instance, banks, customers, recalculation and reperformance of calculations, and there is this observation of inventory counts and asset verification. Analytical reviews also includes analytical procedures, for instance, trend analysis, ratio analysis. By performing substantive testing, auditors gain assurance that financial statements accurately reflect a company's financial position and performance. Normally, these are in the mnemonics A, E, I, O, U. The A representing analytical procedures, E for inquiry, O for observation, I for inspection, U for calculation and recalculation. So that is it. When you realize you know your vowels, this will be easy for you. After substantive tests in auditing, the next steps typically include 1. Analytical procedures. It's important to evaluate financial data and trends to identify potential errors or fraud. Secondly, there is test of internal controls. It is important to assess the operating effectiveness of internal controls related to the financial statements as well as financial reporting. And thirdly, there is transaction testing. There is the need to select specific transactions to verify their accuracy, completeness, and validity. Can you give an example? Please drop a comment. We are learning. We're all learning together. Fourthly, balance sheet substantiation. It is important to verify the existence and value of assets, liabilities, and equity accounts. You agree with me that some of the assets may have relocated. Only God knows where they are. It is important to substantiate them vis-a-vis their values as stated in the balance sheet or as stated within the assets. Fifth, it is important to carry out the income statement verification. Confirm revenue, expenses, gains and losses. And sixth, embark on a disclosure evaluation where review of financial statement disclosures for accuracy and completeness. Seventh, embark on the need to conclude your audits. It is important to form an opinion on the financial statements, fairness and accuracy. Eighth, audit reporting, where you prepare the audit report including any findings or recommendations. Ninth, communication with management and those charged with governance. It is important to review all those findings and disclosures with them, audited results and recommendations above all. It is worthy to note that the specific steps enumerated here may change depending on the scope of the audit, the risk assessment, and professional standards.